Ever wondered how to make your money work harder for you? Welcome, you've come to the right place. We're not just about saving, but growing wealth strategically. We'll be guiding you through the world of investments, covering key topics every budding finance whiz should know. Along the way, we'll unearth the art of portfolio construction, investigate varied investment types, and help you master investment selection. Additionally, we'll illuminate the often misunderstood investment risk and simplify investment taxation. So, get ready to confidently step into the investment world. Let's delve deeper into these topics, starting with portfolio construction. Constructing a portfolio is akin to building a house. You need a solid foundation, the right materials, and a plan. This concise metaphor summarizes the essence of portfolio assembly. It's not a random selection of stocks or bonds, but it's a careful choice of assets aligning with your financial goals and risk acceptance. Let's simplify it. Picture your financial objectives as your house's blueprint. For immediate big purchases, you'd want a bungalow. For retirement, you'd need a mansion. Your blueprint determines the materials you'll need. The stocks, bonds, real estate, and cash equivalents are some examples. The key word here is diversification. Just like you wouldn't build a house entirely out of glass, you shouldn't construct a portfolio from one type of asset. Diversification helps distribute risk and enhance returns. Now let's consider the foundation of your house, which represents your asset allocation. Essentially, this is deciding the percentage of your portfolio dedicated to each asset type. It's a balancing act between risk and reward. Higher risk could mean higher returns, but also a higher chance of losses. Your asset allocation should mirror your risk tolerance. If you're young and risk tolerant, you might lean towards stocks, offering higher returns, but with more volatility. If you're nearing retirement, bonds and cash equivalents could constitute a larger part of your portfolio. It's important to remember that portfolio construction isn't a one-time task. It's a dynamic process, requiring periodic reviewing and adjusting to mirror changes in your financial circumstances and market conditions. A well-constructed portfolio can be your stepping stone to financial freedom. Up next, we'll explore the different types of investments. When we say investments, what comes to mind? Stocks? Bonds? There's much more to it. Stocks represent a piece of a company, providing potential high returns and corresponding risk. Bonds are essentially loans you give, receiving periodic interest and the principal upon maturity. They're generally lower risk than stocks, but offer lesser returns. Mutual funds pool money from multiple investors for a diversified portfolio of assets. They offer diversification and professional management, but come with fees and can be less tax efficient. Exchange-traded funds, or ETFs, are akin to mutual funds, but trade like stocks, often at a lower cost and with increased flexibility. Real estate can generate income through rent and potential appreciation over time, but requires significant capital and has ongoing costs. Commodities like gold or oil offer a hedge against inflation and diversify a portfolio, but can be volatile and impacted by outside factors. Each investment type has a unique risk-reward profile. Stocks can provide growth, bonds offer income, mutual funds and ETFs offer diversification. Real estate can yield both income and potential appreciation, and commodities can act as a safeguard. By understanding these different types, you can determine which align with your financial goals, risk tolerance, and time horizon. This allows you to create a balanced portfolio that aligns potential returns with risk, assisting in achieving your financial goals while offering you peace of mind. Understanding these investment types will help you make informed decisions. Now, let's discuss how to select the right investment. Choosing the right investment can seem daunting, but with the right attitude, it can be manageable. Envision entering a broad market filled with various products. Your job is to pick those that fulfill your requirements. This principle is similar when your investments. First, ponder your financial objectives. Are you saving for a new house, retirement, or your offspring's education? Your aims will guide your investment choices. Preparing for a long-term goal may orient you towards equities or real estate. Short-term objectives might call for safer, like bonds or fixed deposits. Next, gauge your risk tolerance. Are you okay with your investment value varying, or does this notion unsettle you? Your risk tolerance can guide your decision between volatile options like stocks and stable ones like government bonds. Also, contemplate your investment duration. Investments need time to mature, and the available time can impact your decision. Research and due diligence are indispensable too. Scrutinize the past performance of your chosen investment and the competence of the fund manager and the prevalent market conditions. This will assist you in making an enlightened decision. With a thoughtful selection, you can build a portfolio that is in sync with your goals. But remember, every investment comes with risks. Risk and investment are inseparable. To manage these risks, you must first understand them. The world of investment risk is populated by four main players. Market risk, the first player, is the volatility of the entire market, which can drag your investments down with it. It's akin to a tide that lifts or sinks all ships. The second player, credit risk, is the possibility that the entity you've invested in won't be able to repay its debt. It's similar to lending money to a friend who can't repay you. The third player, liquidity risk, is the risk of being unable to convert your investment into cash when necessary. It's like owning an attractive house in a deserted town. No buyers, no value. Lastly, inflation risk, the fourth player, is the danger of your return on investment not keeping up with inflation, thereby reducing your money's buying power. It's like running on a treadmill that's gradually increasing its speed. The way to manage these risks? Diversification and asset allocation. By diversifying your investments across various asset types and sectors, you can minimize the effect of a single risk. It's the equivalent of not putting all your eggs in one basket. Investment is not just about returns, it's about managing risks. Let's now turn to one of the most overlooked aspects of investment: taxation. No one likes paying taxes, but understanding how investment taxation works can help you keep more of your returns. As investors, taxes can seriously impact your profits. Therefore, it's crucial to understand the tax implications of different investment types. Essentially, investment income can be interest, dividends, or capital gains, each taxed differently. Interest income from bonds or savings accounts usually gets taxed at your regular income tax rate. Dividends, profits shared by a company with its shareholders, can be either qualified or non-qualified, taxed differently. Capital gains, profits made when you sell an investment higher than its purchase price, are also taxable. In the UK, you pay capital gains tax when selling shares or property, and there are two rates, one for property and the other for different assets. Your overall taxable income decides the rate you pay. The notion of capital gains tax introduces us to tax-efficient investing, a strategy to manage investments to minimize tax liability. For example, holding investments longer qualifies for long-term capital gains rates, typically lower than short-term rates. Selling investments at a loss to offset gains elsewhere in your portfolio can also lower your tax liability. However, tax rules are complex and frequently change. It's wise to consult with a financial advisor or tax professional to ensure tax-efficient decisions. Remember, it's not just about how much you make, but also how much you keep after taxes. With this, we conclude our brief journey into the world of investments.